While the markets are absolutely collapsing right now, everywhere we look, we are seeing stocks in a free fall. We are seeing gold miners down. We're seeing bonds take a huge hit as the market is starting to price in the much higher likelihood that the Federal Reserve raises rates, number one, but also raises rates even more than everybody thought they originally would. And crypto is also collapsing. So this is everything coming together all at once, and everything is one trade. This is what I've been saying for a very long time now, that as the over financialization of an economy takes place, really everything turns into one trade. Everybody's watching monetary policy. Everybody is watching the Federal Reserve. Everybody's saying what will happen with monetary policy, because the price of anything else will either go up or down based on monetary policy. This is one of the signs of extreme aging of an economy, where it's getting to the end of its life cycle because everything has become so dependent on monetary policy to survive, just basically getting free money. And so when we take a look here at gold, we are seeing gold, major down day. We are seeing silver, major down day. We're seeing Bitcoin just dropping off of a cliff, major collapse. Note about Bitcoin here, today's sponsors, I Trust Capital. They are the best way to invest in Bitcoin, other cryptocurrencies, gold and silver with your retirement money. If you have retirement money in an old 401k, an IRA, you want to make new contributions, use I Trust Capital, and you can invest in gold, silver, Bitcoin, and other cryptocurrencies the cheapest, easiest, safest way with your retirement money. If you use my link in the description below, you get $100 off, or $100 worth of Bitcoin just for signing up. So if you take a look at Bitcoin, it's in a free fall here. I recently did an interview with Gareth Soloway, and he absolutely pegged this perfectly. Bitcoin was at that point, it was right around here. I believe this was right at the end of May when I talked with him, and he said, hey, look, the setup here, technically speaking, is for a rally to 32,000. He might have said 34,000. And he said, after that, we're looking at hitting 20,000. And so far, pretty much has pegged that exactly here, where we hit 22,000, not all the way at 20. The one thing here, though, that I'm looking at is that technically speaking, there's not a whole lot of support for Bitcoin at 20,000. There is a little bit here because it was a short-term top in December of 2020, and then it was a very short-term top there in December of 2017, but there's not a lot of support there in terms of volume and in terms of how many times the price has bounced off of 20, either as support or resistance. But there is a lot of support and resistance down here at 12,000. You can see right in this range, it's a much stronger support and resistance line there, right around the 12,000. And so if we do continue this bear market here, even for a couple of days, we could easily see it burst through that $20,000 mark, go down to 12. In my opinion, if it does that, huge buying opportunity there, because it's still got that asymmetric upside. It's all a matter of, will it become money in the future? Will more and more people use it in the future versus not? And the rate at which governments are systematically destroying their currencies, I think the likelihood is higher yes than no, but even if it's a 5% chance, then it's still an asymmetric bet to the upside there. So that's still my view on Bitcoin. That has not changed. We are also seeing stocks just in an absolute free fall here. They've fallen below their all-time lows so far for the year here. The S&P 500 has not been this low since March of 21, when it was in its massive bull rally right after all that free money hit the economy there. And now we are seeing the cost of all that free money, right? Not exactly free. And so it's falling. We are officially in a bear market now with the S&P 500. We've been in the bear market now for a while with the Russell 2000. And the big thing here is rates. So take a look with me here at this 2-year rate, absolutely just spiking. This literally looks like price action of a crazy penny stock, crazy altcoin, something you would not imagine that the chart for this, the percentage moves for the interest rate on the 2-year government treasury would look like this, but it does. Very, very briefly inverted today. In fact, right now, as I'm recording this on Monday night, the 2-year and the 10-year is inverted. You can see there the 2-year yield is 3.367 and the 10-year is 3.362. And so that means the short-term interest rate is higher than the longer-term interest rate. The 2 and the 10 is usually the yield curve indicator that people look at to wonder about whether we are going to have a recession or not. So inverted yield curve versus normal yield curve. Normally, the further out you go with interest rates, the higher those interest rates are going to be. Why is that? Because more time carries more risk, and so you demand a higher return on your capital in order to compensate you for that risk, because more things could happen in between now and then given more time. But when the yield curve becomes inverted, suddenly people who are lending at those shorter interest rates are getting a higher interest rate than the longer interest rate. And the reason for that is because because the higher and higher chances being priced into the market for something like a recession, a big crash, a depression, something crazy happening. So you might think, okay, well, why would that mean that the longer term interest rates are lower than short term? That still doesn't make sense. And it doesn't outside of intervention. This is where monetary policy comes in. Like I said earlier, everything is one trade. And so when you have the longer term interest rates lower, that's the market saying that, hey, in the future, we expect interest rates to be pushed lower compared to today. Well, why would that happen? Well, inflation is persisting. Inflation is not proving to be transitory. Inflation is very persistent. Every single month, we're no longer hearing people talk about peak inflation because the inflation readings for May were higher than they were for April. Now everybody's expecting the Federal Reserve to come out this week. The big question is, what's the Fed going to do? The Federal Reserve now has to make the choice, and many people are now expecting the Federal Reserve to come out and say another 50 point or another 75 basis point, maybe even a full 1% rise in the federal funds rate. And that would be an enormous move, historically speaking, for the Federal Reserve to move the Fed funds rate up by that much. But the problem with doing something like that is that you harm the economy. You make money a lot harder to get. You make the cost of servicing debt and rolling over debt even higher. And so you create a liquidity crisis where more and more money gets sucked out of the economy, and you set up the chances, the much higher chances of a recession or a crash or something very quick and catastrophic happening to the economy. Some big player, a big hedge fund, big bank, something like that, saying, hey, we're insolvent. We couldn't get the money that we needed. And so when you run those higher risks, now the market is pricing in the future beyond that risk, beyond that recession or that crash. And they're saying, hey, the Federal Reserve at that point will step in and they'll lower interest rates again to boost the economy after things crash. And so the market right now, with the 10-year being below the 2-year, is saying we have a much higher expectation that between 2 years and 10 years, there will be some sort of a crash that will cause interest rates to be lower than they are today. And that's it. So it's not a natural market phenomenon. That is simply expectation of intervention by a central bank. And that's why something like a yield curve will invert. And it highlights between the rock and the hard place that the Federal Reserve is in right now that I've been talking about forever, that when you get to this point, central banks, monetary policy, you have to choose between saving the currency or saving the economy. We have simply spent too much of our future purchasing power. We have leveraged up our economy too much. Whether you look at household debt, corporate debt, or government debt, we have spent too much money and borrowed too much and leveraged up our economy too much. Leverage is simply pulling purchasing power from the future into the present. So that purchasing power is spent already. There's no way around it. You either have a deflationary deleveraging or an inflationary deleveraging. And the Federal Reserve, the one in control, the central bank, the one in control of monetary policy, they are the ones who choose whether you save the currency and crash the economy or save the economy and crash the currency. So you either have the inflationary deleveraging where you save the economy, but you crash the currency and it hyperinflates, or you have a deflationary deleveraging where you choose to try and save the currency, but you crash the economy. So prices go down instead. Either way, you get the deleveraging, and that is the rock and the hard place that the Federal Reserve is in between right now. And we will just have to wait 2 more days as of the time of this recording for Wednesday to see what they say they are going to do. In my expectation, they are probably going to say, hey, we're sticking to the path that we're on. We're not going to do anything crazy because they don't care about the stock market. They say we're not going to do anything crazy because they don't care about the stuff happening right now. They don't care about the stuff that people expect might happen in the future. They are so backwards looking, it's not even funny. They look at the data as it comes in from months behind. They are very rear view mirror looking. And so they are reactive. They are not proactive. So my expectation is they'll continue on the path that they're on, selling assets off of their balance sheet and raising interest rates by 0.5% at a time. And we'll see where that takes us, but I will update you as soon as they come out with their statement on Wednesday. Other than that, nothing else for you today. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.